Want to know the secrets to Warren Buffett's legendary success? Today, we're diving into his 4 golden rules of investing, the principles that have made him one of the most successful investors of all time. Whether you're just starting out or looking to refine your strategy, these timeless rules will transform the way you think about investing. Stick around until the end for actionable tips that could make a huge difference in your financial journey. Now let's start with rule number 1. Focus on the businesses that you truly understand.
Old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. So defining your circle of competence is the most important aspect of investing. It's not how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
Buffett's first rule emphasizes the importance of staying within your circle of competence. This means focusing on industries, businesses, or sectors you truly understand. For example, if you have extensive experience in the restaurant industry, you'll be better equipped to evaluate companies like Chipotle or Domino's Pizza. Your familiarity with trends, customer preferences, and operational challenges in that space can give you a significant edge in assessing their potential for long-term success. Here's where many investors go wrong. They chase trendy assets like AI stocks or cryptocurrencies without truly understanding them. If you have to ask whether you should invest in something, that's often a sign you don't fully grasp it. Buffett stresses that the size of your circle of competence isn't as important as knowing its boundaries. Stay within what you know, and don't get swayed by excitement or peer pressure. Once you've defined your circle of competence, the next step is knowing when to act. Let's move to rule number 2. Act decisively on golden opportunities.
Opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come. Because you're not going to get 500 great opportunities.
Opportunities in investing don't come around often. Buffett's second rule is to act decisively when something big and right comes along. Hesitating or acting on too small a scale can be just as costly as missing out entirely. In the last 50 years, we've had only 4 truly exceptional stock market opportunities: the Black Monday crash, the dot-com crash, the global financial crisis, and the 2020 stock market crash. That's roughly once a decade. Buffett likens this to baseball. When the perfect pitch comes right down the middle, you've got to swing. But if you hesitate or swing too late, you'll miss it entirely. Preparation is key here. Do your research. Understand what you're investing in. When the moment comes, be ready to hit it out of the park. While seizing opportunities is important, the way you react to the market is just as critical. Let's dive into rule number 3. Control your emotions.
The answer is that investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow. Or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity. Just huge opportunity. You will see things you won't believe in your lifetime, and securities markets. The country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but you want, it doesn't take brains. It takes temperament.
Buffett's third rule is simple but crucial. Control your emotions. Many investors lose out by making decisions based on market trends or fear, yet human behavior often gets in the way. During bull markets, people get overly excited and pile in at the top. During downturns, they panic and sell at the bottom. Last year, for instance, some investors pulled out millions before 2024, fearing a crash. Instead, the S&P 500 surged nearly 30%, costing them massive gains. Buffett's advice? When in doubt, zoom out. Look at the market's long-term performance, which has weathered countless storms and always recovered stronger. Investing success isn't about intelligence, it's about temperament. With emotions in check, Buffett's fourth rule teaches us how to use market sentiment to our advantage. Rule number 4, be greedy when others are fearful, and fearful when others are greedy.
Behave very peculiarly in terms of the reactions, because they're human beings, and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful. And they'll continue to do so. And you will see things you won't believe in your lifetime. And securities markets. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some percent of their new money in stock because they were wild about stocks. Then they got a lot cheaper, and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. Investors behave in very human ways, which is they get very excited during bull markets, and when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push up prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business, and it's astounding. But that makes for huge opportunity. Just huge opportunity.
This final rule is all about thinking differently. When others are panicking and selling during a market downturn, that's when you should be buying. Conversely, when everyone is euphoric and buying at high prices, it's time to be cautious. Take the 1970s, for example. Pension funds heavily invested in stocks when prices were high, but slashed investments to a record low when stocks became much cheaper. This emotional behavior creates opportunities for those who can stay disciplined. But this only works if you've done your research. Understanding why the market or a stock is down helps you separate real risks from opportunities. By staying prepared and thinking independently, you can capitalize when others are hesitant. And there you have it. Warren Buffett's 4 golden rules of investing. 1. Define your circle of competence. 2. Seize golden opportunities. 3. Control your emotions and stay the course. 4. Be greedy when others are fearful and fearful when others are greedy. These rules may sound simple, but mastering them takes discipline, patience, and action at the right time. If you found this video helpful, make sure to like, subscribe, and share it with someone on their investing journey. And tell me in the comments, which of these rules do you think is the hardest to follow? Thanks for watching, and I'll see you in the next video.